Let's start off with the first question. Do you expect the economy to be in recession by the end of 2023? Yes or no is the first question. Pretty important question as well, something we're grappling with. As I was saying, the theme of our QEO this quarter is the great rebalancing, and it's got a question mark at the end of it for a reason. The reality with the New Zealand economy in the last few years is it's built up some pretty significant imbalances. And we can see those in a few key areas. The most obvious and high profile one is the quite high level of inflation that's really accumulated. But we've also got a very high current account deficit and an elevated fiscal deficit at a time where you might not necessarily expect there to be one, given that the unemployment rate is near historic lows and the labour market has generally been quite strong. And one of the theme that we've got there is that there is a need for the economy to rebalance so that all of those things go back to something a bit closer to what we typically would like to see on average over the business cycle. But the question we have is, to the extent to which is that going to occur, and is it going to occur in a timely enough fashion, and will there be a bumpy ride on the way to balance? And that's what that's all about. So perhaps we can have a look at the results of these polls. I can't really see very well from this thing, but am I seeing there 70-odd%? Okay, so there's a little bit more optimism actually in Auckland compared to some of the other places. Only a little bit. Should we be surprised by that? I don't think we probably should. If we go into what our economic view is in terms of what the economy is likely to do over the next while, we've basically got a pretty subdued economic outlook expectation. We're basically going to have growth averaging, quite a bit below where it averaged in the decade or so before COVID. 1.2% on an annual average basis. Basically, it's an economy that's going to be very slow and indeed flat over the second half of this year and into next year, and then gradually recovering after that. And what do I mean by flat? Well, I literally mean zero, basically, in terms of growth in the second half of this year. And, I would classify that as flirting with recession. We're not forecasting a recession at this stage, but when you're at zero, it's a 50-50 call, basically, exactly what's going to happen from here. And certainly there are plenty of cyclical indicators out there suggesting that we are indeed heading into the negative category with respect to aggregate economic growth over the second half of this year. Reserve Bank has a recession in its forecast, so they're a little bit more pessimistic than we are. Not dramatically so, though. Actually, they tended to pin those expectations back a bit when they did their monetary policy statement last week. But we are sort of looking forward to, once we get through to the back half of next year, that we'll be back into a cyclical upturn again. But, so I guess the question I often get about this is, well, okay, you're saying that we're only flirting with recession, but why do I feel so bad? Business and consumer confidence is not flash right now. And, businesses, people, households, they're all complaining about all manner of things, whether it be cost increases, level of interest rates, level of inflation, all sorts of things. And the thing that squares that circle is that, whilst at the same time growth is slowing to basically around zero levels, we're having decent levels of population growth, because that migration cycle that I was telling you about last time is still there, it's still happening. We've got relatively historic levels of population growth in the economy right now. So that means on a per capita basis, growth is actually showing a recession. It's going backwards. Basically, each New Zealander's share of the GDP pie is getting a bit smaller over the course of the next year or so. And that's why everybody feels bad, because on an individual basis, it's just not that flash. It's doing it tough. So hence there is a consistency here between those stories. And to some extent I think it reflects the very unusual situation we are in now. We're going to a cyclical downturn, but at the same time as a lot of people are coming here at this, And usually there would be more of a congruence between those things. People often come to New Zealand when we're actually on a cyclical upswing and the labour market is strong and things are looking good. But COVID has really screwed around with a lot of things in the economic cycle in the last few years, and this is an example of that. So thinking about, well, what's really driving the view about why we're going to have this weakness, why we're in this weakness now. And that's a similar story that we told you last time, where basically, the Reserve Bank in large part is engineering this through the quite significant tightening cycle that we've seen in the last 18 months. Interest rates are up 525 points, there or thereabouts. Households are basically having to adjust to that. We think that households are about halfway through in terms of absorbing the cost increases that are coming through interest rates onto their balance sheets. People moving off those 2-point-something mortgage rates onto 6 or 7-point-something. And that's going to kick on and continue until the early to mid part of 2024. Probably got about another 140 basis points or so of cost that have to go into household budgets. And that's going to be a significant weight on the household sector and on growth, and that is essentially what is going on with the economy right now. That story hasn't really changed very much in the last few months, but that is what it is. And if we look forward to sort of where we are on a cyclical basis, this is another way of looking at it. Household spending on interest costs is going from a very, very low point of where it was a couple of years ago, where there was plenty of money in the kitty basically for spending other things while everybody was locked up in home. And now we're basically going to a bit above long run, sort of like average levels of cost. That's a big change around for households. It will take a bit of adjustment. It's going to result in some significant reprioritisation of spending in households, particularly those households that have mortgage debt. Another way of looking at it, though, if you want to have the green hat on, is that we're not really going back to the highs that we have seen in cycles in the past. Interest rates are certainly higher in New Zealand than they have been for a while, but they are perhaps not necessarily high if we look at it in that kind of medium to long run historical context. One of the interesting things about New Zealand households in the last 10 or 12 years or so is that they did actually a decent job in establishing better balance sheets over that period. Household debt did accumulate, but it accumulated at slower than the rate of nominal GDP growth. So that basically put them in a much better position by the time we got to the end of last decade and into the COVID shock than they were when you were thinking about what was going on in the 2000s. So you might argue there that, there's obviously a lot more cost that's going into the budget than what there was a couple of years ago, but it may not necessarily be a disaster, and that's something to kind of think about when we talk about what the potential resiliency of the economy might be to some of the special shocks that are going on at the moment. It's certainly not very good for the business sector. Most of the business sector indicators of profitability, confidence are very weak at the moment. We're staging a reasonably tentative recovery. We'll see what happens as we go through the second half of the year. Businesses complaining a lot about cost increases and margin pressures associated with that. And also, they've been grappling with the difficulty in finding labour. That difficulty seems to have eased a bit in the last few quarters, but increasingly that concern is now being replaced by the ability to find adequate demand for their products. So basically, it's a very negative period for businesses. And that's going to be reflected in things like investment in the business sector. And we can see that in the PMI indicators for services and the goods producing sectors, which are certainly consistent with the idea that the economy is heading towards recession over the next 6 months to a year or so. Next poll question, we'll go into the topic of the labour market next. What are your expectations for wage growth over the next year? It's going to be faster, slower or steady relative to what you've seen in the last year. Tell me. It's a very important question in terms of how this rebalancing process is going to occur. bit of a mix between steady and slower. That's actually probably reasonably congruent with what we saw elsewhere as well. That's an interesting result because the forecasts imply that it's not going to be steady, that it's going to be slower. And indeed it needs to be quite a bit slower because wage inflation is actually very elevated right now, as you might expect, given that the general level of inflation has indeed been relatively high. So if we look at our kind of like wage growth kind of like forecasts, we're basically saying that nominal wage growth has been very strong in the last year or so, and even though it's been strong, it hasn't actually kept up with the rate of inflation. So nominal wage growth is going backwards. So, and that's an interesting observation. So basically we've got an idea about, well, we need to think about, well, to what extent a wage is going to correct over the period ahead. And you've got this kind of battle that's going on between labour and businesses at the moment about whether workers are really going to be happy to accept that real wage cut that they've seen in the last couple of years. We've seen it with the industrial action. We've got nurses and teachers and any number of groups, even people who work at the bank here, basically having a debate with management basically about what wage growth would be. But the reality is, for us to see the economy rebalance, basically are expecting to see labour cost growth to decline quite significantly and very soon, basically to be sure that inflation is going to come off these very high levels. So we've basically got an expectation the unemployment rate is going to drift up basically to the sort of like low 5.2, 5.3% mark, and that wage costs are going to fall to around about 2.5 or 3% basically on a LCI basis. Those things are obviously very closely related. So basically the extent to which the labour market adjusts will critically determine how fast wages will adjust, and they'll probably also be quite important for understanding how inflation will come down as well. And one of the interesting things that we've seen in the last 6 to 12 months or so is that the labour market has been relatively resilient in the face of the quite significant interest rate increases that have occurred. What about supply and demand in the labour market? What is going on there? You will recall last time I came here and told you the story about a really big swing around in net migration and population growth that had started to occur. And what I can tell you is that the story that we told you last time in terms of what was going to occur is pretty much panning out. We've got a shade less increase in migration than we thought last time, but it's really only a shade. Basically, instead of getting to 100,000 people coming to the country, we think it'll be only 90,000, still very high on a historical basis. So what that basically means is that all of those migrants that I was telling you about last time that had a visa and willing to come here, they're still coming. There's been no slowdown at all. And as a result, we still have confidence in the idea that the migration cycle has still a fair way to play out yet, and that's supporting both the supply of labour into the labour market and also the demand in the economy, given that all these people are coming in here and they're finding somewhere to live, they're consuming goods and services, their kids are going to school, etc., etc. And that's kind of that interesting conundrum I was talking to you about earlier about, well, I mean, we've got apparently recession-like conditions, but we're not really seeing a very strong signs of actual outright economy going backwards, and it's because the economy has been supported by this relatively strong inflow. One thing that has changed a little bit at the margin is there has been an increase in outflows of people, and particularly outflows of New Zealanders leaving, and obviously you would have seen that in the discourse if you're reading the newspapers. So, you can see the red line there, that's the New Zealanders leaving, it's going back up to cyclical highs. The story that we're telling there is that that's largely the flip side of what happened to New Zealanders through that COVID period, where you see that a relatively few number of New Zealanders left during COVID, because why would you? You wouldn't know if you're going to be able to come back, and it wasn't clear that it was going to be a great place to go anywhere else anyway. But nevertheless, that's a delay in plans rather than a cancellation of plans. So I think the view that we have here is that what we're seeing will basically play out over the period ahead. People that otherwise would have left will leave, and then things should settle back down to some sort of like average level. As I said, the labour market has shown significant signs of resilience, and one clear area of that resilience is in the level of employment growth. So that's these pink bars on this chart here, which are still resoundingly positive, which is pretty unusual in the context of an economy that is supposed to be heading into recession. It's not very usual for that to be occurring at all. Maybe it's still to come in front of us, but the reality is that if you'd asked anybody, including the Reserve Bank a year ago, would you be expecting to see the labour market with very strong employment growth, the unemployment rate only having ticked up a few bits of a percentage point relative to historic lows, in the face of the interest rate increases that have occurred? They would not have, nobody would have told you that would have happened. We would have expected more weakness in that. The fact that there's been that resilience explains why it's taken so long for inflation pressures to really peak and come off so far. And the outlook for this labour market really is quite critical in terms of the speed at which this economy is going to rebalance as we go forward. We do have some tentative signs that things are getting better. In the labour market, there does look like there's a bit of balance between supply and demand in the labour market, and we can see that in the intensity of advertising for workers. So basically we see online job ads basically coming from really high levels back to kind of like long run trend levels now. So that suggests that with that better balance, there are some good reasons to expect that this rebalancing in the labour market is going to occur. We're still not at very weak levels yet, and that makes sense considering the unemployment rate's still around 3.6, 3.7%, which is a very low unemployment rate by New Zealand standards. The other area of change, in our view, is in terms of thinking about what the housing market's going to do. So basically, you might recall last time I told you a story that, we basically didn't think that house prices were going to continue to fall, that they were going to find a base and basically just track around with the level of inflation. Now, I told you at the time that was a bit weird, because we've actually got historically strong population growth, the sort of population growth we haven't seen since the 60s. And normally there would be a relationship between population growth and house prices for obvious reasons. People are going to come here, they're not going to live in a cave, they need to live somewhere, right? They'll buy it or they'll rent it, and if they rent it, the rentals will go up and that'll encourage people to buy things to rent out. So we've put a bit of that into the forecast now so that we have got something that looks more like a normal cycle in house prices beginning basically next year. What can we say about the dynamics in the house prices that we've seen so far that gives us some confidence that we're at least on the right track there? Well, it's certainly the case that house prices have found a base, and indeed they're rising nationally now. It's obviously a really big change in view from where a lot of people were even a few months ago. There were expectations of further significant falls in house prices, but basically we're at the point now where it looks like that house price cycle correction finished at about minus 17% annually, and now we're up a couple of percent or so from those lows. We're not really anticipating very much in terms of house price growth through the balance of this year, basically just trucking along at about the level of inflation. But next year, given that there tends to be about a 1 year lag between when net migration cycle starts heating up and house prices, that's when we're expecting to see it. And of course next year as well, we'll basically be thinking that most people in the economy will be looking forward to the potential for interest rate cuts as well, which will also be a bit of a fill up to that property market. What does that mean for the construction sector? What that means is that we're going to have a really flat period, the time for a while, reflecting the fact that the housing market has been weak for a decent period. But then after we get through the back end of this year and into the second half of next year, we should be starting to see things start to pick up a little bit. But it is definitely the case that the construction sector is not going to be a source of strength for the economy in the immediate period ahead. It's one of those interest-sensitive sectors, and as a result, it will be among the areas that's really leading the negativity. So the other area I want to talk about in terms of rebalancing is the fiscal position. As I mentioned earlier, the fiscal situation, we've got a fiscal deficit at a time where maybe you wouldn't really expect there to be one. Typically, if you cyclically adjust the fiscal deficit, you might anticipate that when the unemployment rate is at near cyclical lows, that the budget would be more or less in balance, or maybe even have a bit of a surplus. Because what happens when you go into recession and as you cycle down again, the automatic stabilisers kick in revenue falls off, expenditure goes up because things like social spending and stuff have to go up, and you go into deficit. And unfortunately, what we're seeing now is that we're seeing those automatic stabilisers start to kick in because nominal GDP growth is coming in lower than what Treasury expected even when they did the budget a few months ago. So you can sort of see that difference when you compare the path for nominal GDP in our forecast compared to what was in the budget. The red line is obviously a bit lower than the blue line. And that basically means that revenue is falling short of expectations. And it already has. Like even for the last few months of last year, the government came in with just over $2 billion less revenue than they expected would be the case. We anticipate there'll be another $6 billion short this year. So basically that's a deteriorating fiscal position, as I said, totally expected given what you would anticipate the economy is going to do. But it means that, you know, the prospects of a return to surplus look far off right now, and indeed there's not really any signs of rebalancing in the economy coming through from the fiscal situation at this point. It'll be interesting to see what the government says, what Treasury says when they update their fiscal accounts with the preview in the middle of next month, but we would expect to see that it's going to be quite a long time before they see any signs of surplus. And indeed they probably will have to increase the amount of debt securities they offer to the market for the current year to account for the losses in tax revenue that they're already seeing. And, you know, our forecasts basically only really deal with what we're expecting to see from the revenue side. On the expenditure side, you can kind of really see what the challenge is going to be for governments looking forward if they want to rebalance this budget. And the issues there is that this red line basically shows, based off forecasts, you know, what government spending per person is going to be doing over the forecast horizon. And what we can see here is that it's falling quite significantly. And if you look further back through the history, and there's quite a bit of history there on that chart, you see that it doesn't fall very far, very much. And that's because that red line falling basically means the government's going to be providing less services per person. That's a hard thing to do, right? That's less education, less healthcare, less of anything that you get from the government. And, you know, the reality is that there's probably some scepticism that that's a reality that's going to happen, that there's probably actually going to have to be a bit more spending than what is currently in the books right now in the out years. So if that's the case, then that would add to the deficit basically that we've got in the previous slide. And, you know, the message that we've got there is that future governments have got some pretty tough choices to kind of like come through, both in terms of the prioritisation of spending, but also potentially in revenue initiatives as well. Because it probably, you know, it may not be very sustainable to continue to run large deficits in permanence. And, you know, currently the government's fiscal rules are such that they should be forecasting a return to surplus within the forecast horizon. Our issues are not so much that we've got too much government debt, we've actually got a very low level of government debt. This is more about the trajectory of that debt as we go through time. So in terms of the external sector and sort of the global economy, what have we got there? Well, that's also not a very positive story. For the global economy overall, what we've got is basically a fairly subdued outlook. Basically, growth is not really going to be picking up over the next few years. If I compare this to the forecasts of my ex-colleagues at the IMF, I mean, basically they have a tendency to be a bit more optimistic about the world, and they're not. They've basically got the weakest global outlook that they've been projecting since the GFC. So, and that's because the whole world is grappling with the same sorts of issues that New Zealand is at the moment. It's the post-COVID runoff, basically, after a few years of relatively overheated economies. It's monetary tightening that's occurring everywhere in the world, which is weighing on growth. And we've just got this long period in the world where growth is going to run lower than trend levels to basically help unwind the inflation pressures that have emerged in the last few years. You know, the more interesting aspect of this is really in terms of the situation in China, because that's where actually the pointy end really is for this in the New Zealand forecasts. And what we can see there is that, you know, China's obviously a major trading partner, and it's also the area of the greatest level of disappointment. right? Last time I was here, I was telling you a bullish story about China. I was saying, well, they were a bit later to open the gates after COVID than anyone else, so we were expecting there was going to be a decent bounce back and growth there, and we were going to benefit from that. That's not panning out. So as you can see from these lines here, growth forecasts for 2024 and even for the current year are just steadily getting revised down because the information coming out of China is not good. Basically, they've got a very weak construction sector, relatively high youth unemployment in general, and that's causing consumers in general to basically pull back on spending at a time where we hope that they would be spending a bit more. Where is that being reflected? Well, it's being reflected across the bulk of our agricultural commodity exports. Meat, wool, and especially the milk price, which has been revised down quite significantly by Fonterra recently. We made our own revision down at the start of this week to match where Fonterra has. $6.75 is the forecast for the current year. At that payout, basically, most farmers won't be making money. So that means that, you know, from the agricultural sector's contribution to growth is not going to be very significant this year. It's going to be pretty tough out there in the regions and for those sectors that are reliant on the spending in the farming sector. You know, basically the farmers, they won't be investing as much in plant and machinery, on trying to reduce on-farm costs as much as they can to get through this relatively weak period. Our outlook for commodity prices in general is relatively subdued. We're basically seeing a down cycle in commodity prices over the next year or so, but it is a cycle. It will improve. It always does. Supply eventually does equal demand in these things, but it's just going to be a pretty rough period for the next 18 months or 2 years as we go through this cycle. So what are the bright spots in the external outlook? Well, the bright spot is really tourism, and that's still remaining to be something that we're kind of hanging a lot of hopes on in terms of like having some support in the economy over the period ahead. We're about 2/3 of the way through the bounce back from the sort of like the closure of the tourism sector through COVID. You know, we've just had a pretty decent World Cup. Airlines are bringing on capacity, which gives us confidence that they're bringing it on because they're expecting some people to come. I did a presentation in Queenstown yesterday, basically, on this, and you know there was plenty of activity going on around Queenstown, as you might expect. So you know that's going to be the thing that firms that are basically involved with the tourism sector or recreational services, those sorts of things that people do, and when they're here on holiday, should still be seeing reasonably good conditions over the period ahead, which I'm sure will be good news. But the bottom line impact of all of this for the external sector outlook is not flash. We basically have got a very high current account deficit at the moment, 8.5% of GDP, there or thereabouts at the moment. We're anticipating that there'll be some correction of that back to closer to 5% of GDP over the forecast horizon, but it's not a full recovery of that back to closer to where we would expect it to average out in New Zealand, perhaps around 2%, 3% of GDP. So that's an area where, you know, thinking about that theme of rebalancing, there's only really partial rebalancing there. And I think the story I'm telling there is that, you know, this is an area of risk potentially for the economy given the juncture. So we've got this twin deficits issue at the moment. We've got a current account deficit and a fiscal deficit. We've also getting hit with a terms as trade shock at the moment because of the weakness in China and global conditions in general. The current account is one of those things that doesn't matter until it does, and when it does, it's quite serious. And how it would typically play out would be in terms of the exchange rate and in funding costs. This current account deficit basically means that every day we're relying on the savings of foreigners to basically keep things going here. And if something came along to make those foreigners less keen on financing us, that will have implications for domestic interest rates, business financing costs, etc. And clearly the exchange rate as well, which by and large has tended to go sideways or so in the last few months, but there probably are some risks that it goes down. In terms of the inflation outlook, key poll question: when will the CPI inflation reach the Reserve Bank's 1 to 3% target range? Is it going to be June 24? Is it going to be the end of next year? Or will it be in 2025 or later? Please tell me. Adrian Orr needs to know. Interesting. So you guys are a little bit more optimistic than the rest of the country, actually. I would say that the consensus out there in the rest of the country is that it's going to be 2025 or longer. I still see a decent amount of scepticism that it's going to happen over the course of 2024, which is interesting since the Reserve Bank's consistent view in the last year is that they should be getting this inflation rate back inside the target range around about the third quarter of next year. In their judgment, I suspect that's about as far as they think they can reasonably push it before they start worrying about having some risks about inflation expectations and ultimately threatening the ability to get this inflation rate down without causing too much damage. So, what is the situation with inflation? Basically, it's still far too high. Goods prices are coming off a bit because all of those supply chain issues that we were worried about a while ago are coming through now into the CPI. So that's encouraging. But the really challenging bit is services. And the services are quite tightly tied to wages because wages are an important part of producing services. And those are still at high levels, much higher levels than are consistent with the inflation target range. And I would say that you can draw this chart for most of the major countries of the world and see the same sorts of trends. It's that kind of like shift away from goods into services, which has mean that inflation is remaining persistent in that kind of core part of the CPI. And, it reflects people's behaviour. During COVID, we were all sitting at home on our Pelotons, buying things on Amazon.com, or you would do if you're in the United States. I don't know, I guess you bought things off the Noel Lemmings website or something here. So you're buying goods because you couldn't consume services. Well, now people want to consume services. They want to go on holidays, they want to go out for dinner, they want to have experiences that they missed out for a couple of years, and that's demand that is really continuing to hold up that part of the economy. It's also the bit that the Reserve Bank really needs to conquer if they want to get this inflation rate back in the target range. So as you can see, if we kind of look at where core inflation is compared to headline inflation, headline inflation has started to fall back a bit, and that's because of all of these supply chain type issues that really gave it a particularly large boost through 2021, 2022. But the Reserve Bank's preferred core inflation measure basically is still at highs and seems to be going sideways. There's a few other core inflation measures you can look at as well, like the median and the trim mean, etc., all telling you a very similar picture that despite the fact that interest rates have gone up an awful long way, core inflation pressures are not yet budging, and that's a concern. It's a concern, particularly because of the distance that there is to travel between where inflation is now and the target range. And I think I told you the story when I was here last time, and I worked at the bank for a long time, 20 odd years, and all of the monetary policy cycles were usually focused on trying to bring inflation down maybe 1 percentage point, which you can kind of do with a pretty conventional sized tightening cycle, maybe 150 points or something like that. Well, this is a 3 or 4 percentage point job, which apparently needs to happen in about 1.25 years. That's a big job. And I would suggest to you that, all going well, maybe it can happen, but there's got to be some risk that it takes longer. So hence that kind of 50% of people up there are saying that it might take longer. I understand your perspective. I have those concerns myself. In terms of where the inflation is going to be coming from over the course of next couple of years, basically what we're anticipating is that tradables inflation, imported inflation, should collapse to nothing. Right, so that's all those supply chain issues kind of like coming out of the economy. We actually don't have much going on with the exchange rate, so that's not contributing much. So that's the thing that's kind of pushing the headline rate down relatively quickly as we go through the next few quarters. And we have also a significant decline in non-tradables or core inflation. It's a little bit more muted because that's a bit stickier. But even so, given that we've got the housing market predicted to improve a bit over the course of the next year, it means that sticky non-tradables inflation is going to lurk around at relatively high levels for longer. And that means that if we put that all together in terms of what the path is that inflation is going to take as it goes back into the target range, we see that we get into the target range in another year or so, but then inflation lurks around towards the top end of it after that. And I would categorise this as an all going well forecast. We haven't got a big exchange rate depreciation in there. We don't have oil prices like rising. We don't have anything else that comes along that might disturb that disinflationary process. We assume that those wages come off and come off reasonably quickly to allow those core inflation pressures to subside. Even so, it will be over 3 years that we will be outside the inflation target. And the longer that this goes on, the greater the risks are that inflation expectations become embedded in the economy and it just becomes harder to do. I'm sure we've all had the letters in the mail recently from any man and his dog wanting to put the price up for something, and it's usually like 5 or 10% or more. You know, like you didn't get those letters in the 1990s and the 2000s when inflation was lower. So what does this mean for the Reserve Bank? We have a view that they've got a bit more work to do. So the forecast, we've basically got another tightening after the election in the November MPS. Another 25 points taken up to 575, and then it has to stay up at that level until the August MPS next year, where hopefully that progress on inflation has been made, and at which stage there will be scope for a gradual decline in interest rates, basically 25 basis points a quarter after that. So that's a higher for longer type forecast, and it's obviously been significantly increased in the back end relative to what we had before. We've had to push out the time of when the next tightening occurs because the Reserve Bank told us quite stridently in May that they didn't want to do it. We've got to August now, and now they're saying they might have to do it. So they have a bit of a journey to go, but they are heading in the right direction. There's a big range of outcomes that could happen here though. I mean, I'm talking about my point forecast here, but the reality is that you can see it both ways in terms of how interest rates really go over the course of the next year. If I want to think about sort of like some risks on the upside, about if inflation ends up being more persistent than assumed here, the housing market's a bit stronger, maybe the exchange rate comes off and adds a bit of tradables inflation into the mix. Those are the sorts of scenarios in which it won't just be 575, it'll be interest rates heading to 6 or perhaps slightly higher than that. And that seems quite plausible given the very high elevated level of inflation now. But on the other side, we do have this really big negative terms of trade shock that's hitting us right now. There is the potential that that will save the Reserve Bank's bacon here and really add some disinflationary pressure on top of what interest rates would have otherwise done. And in which case you might have the potential for some modest interest rate cuts as we go through into next year. But probably the thing there is modest, because it's, regardless of what happens, it's going to be a long path for inflation to get down to anywhere near 3%. And that's really going to constrain the ability of the Reserve Bank to cut rates too much while that inflation remains relatively elevated. Exchange rate, interest rates. Last poll question. What's the biggest risk for the Kiwi-US exchange rate over the next year? A 5% depreciation or a 5% appreciation? What's that, 70-30? Oh, yeah. I mean, believe it or not, that's actually probably a relatively optimistic view. I mean, it was a bit more unbalanced than that in some of these other centres. But I would agree to you. I mean, I told you the story about some of the risks and things like that. That's certainly the kind of possibility that could occur here, that we do actually get a weaker exchange rate. But as I told you, if that's what eventuates, then that will put the Reserve Bank in a pretty tricky position, because you'll be adding some tradables inflation on top of that non-tradables inflation we've already got there. And that will probably just delay the return of inflation back to target. Interest rates, view for interest rates, higher for longer basically. So because that OCR is going to remain relatively high, it means the longer term financing rates should remain relatively high as well. They've been drifting up anyway because foreign interest rates are rising, because this is not the only country in the world where you're hearing this story from economists. Basically inflation relatively persistent, economy apparently resilient to interest rate increases, real problems in getting inflation down. It's a very similar story around the world. Our exchange rate view though, I mean, we've got a pretty boring one in the sense that basically on the medium term at least, we basically see that the New Zealand dollar will track around inverse to what the US dollar trends will be. So we think the US dollar will gradually fall from its relatively high levels it's at now to something closer to average, and as a result the Kiwi dollar will drift up a bit. But Imre's probably got a bit of a story here about what could really happen between now and the medium term, which is possibly quite relevant when you're thinking about planning your business. And with that, I will leave it over to Imre to tell the story about the market.
Thanks, Kelly. So as usual, my job is to take on board all of that macroeconomic insight and combine it with other stuff and come up with market predictions. Predictions for the next 3 months for our main markets that we're concerned with are that the Kiwi-US exchange rate will fall. Kiwi-Aussie, neutral. Short-term interest rates, neutral-ish. And long-term interest rates higher. So therefore, yield curve shape should steepen. Delving into each of those in turn, starting with the Kiwi, the expectation is that we're going to fall further to extend the recent move, and 58 cents is what I've got on it for the quarter ahead. If there was a risk around that number, it would be to the downside. So I see if it broke below 58, then I'd be talking about 55 cents, which is the sort of late last year cycle low that we saw in the Kiwi. So bearish the Kiwi. What did I say here 3 months ago, and how did that pan out, and what did we learn from this? The forecast for the first 2/3 of the horizon was good. We were pointing upwards. And we thought it'd get to 65, got to 64. That's close enough for a crystal ball gaze. It was the abrupt reversal, which was the takeaway here. That's what I'm really interested in. So what happened there? Well, firstly, the up move was associated with an expectation that the US dollar is going to weaken. So Kelly said, we've got a long-term view that US dollar is going to weaken one day. Yes, sure it will. 3 months ago, we thought it would be weakening in the second half of this year as the economy started to slow in response to those high Fed hikes, and the Fed would stop hiking, and it did. It actually went on hold, and the market thought, and then I looked at some of the data in the US, and okay, that's starting to slow down. It all makes sense. US dollar's had its day. Let's move on and sell the US. So that caused all currencies against the US to rise. But then the US economy got a second wind. And some of the numbers coming out of there are actually quite punchy, in particular core inflation indicators. And now the Fed's in a position where it might have to re-hike, so do some more. The jury's still out on that, but that's where the market is. It's been taken by surprise and thinking, this peak US dollar story, we jumped on it too early. It's got further to play out. And right here and now, the US dollar is looking very, very strong along with that resilient US economy. Hard to see that turning around too much over the next few months, so that is the main driver we've got for Kiwi-US falling. It's a stronger US dollar. I would add to the mix though, very important, is the increasingly disappointing economic news coming out of China. And just to kind of quantify that, the bad China news over the last few months has been worth roughly about half of the up move in the US dollar. So remember, the US dollar, apart from reflecting good economic stuff in the US itself, also is a safe haven instrument. So when bad things happen in important bits of the world like China, the US dollar gets a bid. And yeah, we estimate that about half of this total move, including say half of the move in the Kiwi down, is due to that China story. And again, we don't see that changing too much over the near term, over the next 3 months. So for those two reasons, stronger US economy gives you a stronger US dollar, and bad China news will give you the stronger US dollar. We're calling Kiwi-US lower. Right, that's just a little bit of empirical, and most people will know this. The Kiwi moves inversely to the US most of the time. Lately, it's been moving particularly closely inversely with the US dollar. So you can see we've had a bounce in that US dollar in red. We expect that to go further. Therefore, the black line has to go down. It's a very, very good mirror image, particularly lately. Now, in addition to all of that, there's commodities. So if you've been following New Zealand commodities, dairy in particular, but also the other stuff like meat and other things, they have not been doing very well. A lot of that is related to China, but it's not only China. Despite that, the Kiwi dollar at times very closely follows commodity prices. Now, it hasn't much over the last year because there's been other stuff that dominated it, namely this strong US dollar story. But some years ago, markets were glued to GTT dairy auctions. I'm going back sort of 2013 to 2016. We got really big moves of like 20% from auction to auction, and the market thought it was very important to watch it, so it was. And you got very, very close movement between the Kiwi and auction dairy prices. It's kind of ignored it for the last year. As you can see, we've had a sort of a dribble down, but it's been fairly mundane until very recently. We've had a couple of fairly large negative results, and my guess is the market is now attuned to dairy prices once again, particularly attuned to things like the GTT dairy auction. They're going to watch those very closely. If you get negative results, you'll see very clear reactions in the Kiwi. So this is just another little piece to add to that negative Kiwi story. Okay, on Kiwi Aussie, as you can see there, just looking at the pattern over the course of all of this year, it's fluctuated, fairly decent range, but if you drew a trend through that, it's sideways. So you don't even need any science to say that there's no apparent direction in that, and if you only looked at charts, you'd say the outlook for that is pretty neutral. Last time around, 3 months ago, we had a down arrow, and that worked for about 2 weeks. We'll take that, but no, it didn't really work very well at all. And the reason behind that was we were quite constructive on the recovery in China. There were some early signs from early this year, and we thought that they would persist. They didn't. In fact, the news in China went the other way. Bad news in China usually hurts the Aussie more than the Kiwi. Yeah, that's why we got this rise in Kiwi Aussie over the last 2 or 3 months or so. So then you wonder, well, you know, we're painting a fairly gloomy picture of this China outlook, as you heard from Kelly, so why are we not pointing the arrow upwards here? One big reason for that is over the next month, and this is important, I think, for anybody who deals in Kiwi Aussie, is it's Aussie mining company dividend season. Twice a year, they pay out some very big dividends to their shareholders in US dollars. Their shareholders are mostly Australian domiciled. They don't want the US dollars, so they sell the US and buy some Aussie. It's a big Aussie buying season, and it kicks off within a few days. It lasts for 3 to 4 weeks. What's it worth? It ranges between 10 and 20 billion total, but that's the actual buying by the shareholders. Now, the markets know this event. They know it has a temporary effect on the Aussie, so they front run it, they get involved in it, they like to make money from this. So therefore, the actual amount of buying in Aussie is usually much, much more than the 10 to 20. So bear that in mind. You could see some unusual strength in the Aussie in the near term. So that'll kind of offset this China story in the background, at least for the next month, maybe even a bit longer. So that's kind of why I've got the thing going sideways, as well as the fact that there's no apparent direction. Right, onto interest rates. Short-term interest rates, no higher than the peak that we've seen in this cycle, and that is 5.75% in the 2-year swap rate. I would not expect to see it exceeded, knowing what we know now. We would need to see some pretty big upside surprises for that to happen. It'd been 3 months ago, we did actually get up to that 5 3/4, and what caused that was a little bit of, we actually had some strong news on migration, which took the market by surprise. And a bunch of analysts, led by Kelly, said we're going to have higher interest rates, higher OCR, and the market took notice and it started to price in a very high OCR. It priced in something above 6% OCR. Okay, so to get to 5 3/4% again, or above it, you're going to have to price in an OCR which is something greater than 6%. Now, that's not our base case. It's possible, but it's not our base case. So sideways with a upward drift, and I'd say the upside, the risks to this forecast would be to the upside. Another reason for thinking that we should remain inside that recent peak is that the market is fairly well in line with Kelly and team's thinking on the OCR and the Reserve Bank's thinking. There's no major divergence here. So they're pricing in some chance of another hike. Not completely convinced, but there's some chance in there. And therefore, for market pricing to shift, which would move the 2-year swap, you're going to need some fresh, surprising news, which we don't have at this point. So yeah, markets are in equilibrium, they're fairly well settled, and that's all good, no reason for a surprise there. Where could a surprise come from? It can always come from offshore, in particular the US. And by way of evidence, this shows you 3 lines. This is market pricing for the peak central bank rate in 3 countries. You can see the Kiwi one moves very, very closely with the US one. It's almost like they're following each other. Well, clearly the US market doesn't follow Kiwi. They don't care about us. So yeah, it's very much that the New Zealand market is glued to US market pricing, and movements in the US, even if nothing happens here, does often move New Zealand interest rates. Whether you agree with that or not, it's another thing, but that is what happens. So I'd be watching the US market pricing very closely for any clues as to whether our rates could move materially higher or lower in those short maturities. And getting towards the end, talking about long-term interest rates, I've got the 10-year swap here. We're pointing this one upwards. And this is mainly for some reasons which are really to do with supply mostly. You heard Kelly talk about the deteriorating fiscal situation in New Zealand, which means that the government is going to have to borrow more money. It does it mostly through the government bond market. They're going to update the public on this on the 12th of September. So they do a pre-election update. They open the books, and they also tell you what their new borrowing program is, how many dollars each year. Currently, for this current fiscal year, which ends in June 24, back in the budget in May, they said we're going to borrow $34 billion. Kelly and team have estimated that's going to go up for this year alone by another $6 to $40 billion. That's quite a significant increase. Markets have gotten wind of this, and they're quite concerned about this. Clearly, if government wants to borrow more money, people will buy it. Yes, they'll buy those bonds, particularly foreigners who own most of our bonds. They will buy them, but they want it at a cheaper price, or in other words, a higher yield. So yeah, that's one reason why these long-term rates are likely to keep drifting higher, is the supply story of government bonds in New Zealand, because the government has to borrow more money. There's a similar story playing out in the US, where a few weeks ago the government there announced a larger borrowing program, and that had a clear market impact over a number of weeks, and it's still actually playing out. So long-term US Treasury yields have risen in good part for supply reasons in the US. And of course, what happens in the US, as you know, ripples through to New Zealand market, so there's kind of a double whammy going on. And on top of all of that, if you want another one, Japan, which doesn't often get a mention in the global financial market, big movements these days, but there's some big stuff going on there. They recently tweaked their monetary policy. They don't often tweak their monetary policy, but they did, effectively pushing long-term 10-year Japanese interest rates up by about 50 basis points. They said interest rates there are now allowed to rise beyond 0.5%. They can now go up to 1%. That's quite a big deal. There's potential for even further tweaking, which we might hear about this Friday. There's a big gathering of central bankers from all around the world. They go to Jackson Hole in Wyoming each year, and all the majors are represented, and they give speeches and they talk to journalists, and there's a lot of sound bites. Out of that gathering, this Friday and Saturday, markets will be particularly interested in what the head of the US central bank says and what the head of the Japanese central bank says. But yeah, the risks are kind of pointing towards higher rates in terms of what both of those central bankers are doing. So yeah, a whole bunch of reasons for thinking that longer term interest rates can go higher still. And I'm going to finish on one slide which is very slightly academic, but some people will like it. This is a model of what should a fair interest rate for a 10-year government bond be. And the answer is about 4 and a bit. The model says so. Okay, this is a very long-run model. It's got a lot of kind of long-run fundamentals in there, things like debts, debt levels, current accounts, long-run inflation expectations, and so forth. It's a model that Westpac's had for a long time, and it works pretty well to give you a very high-level sense of are the rates, these long-term rates near fair value, or are they a million miles away? The answer right now is they're about right. Another takeaway from this is you can see that around 2020, so in the depths of the pandemic panic, when the governments were stimulating as much as they could, near zero interest rates, buying government bonds through QE, that kind of thing, that depressed interest rates to ultra low levels, lowest ever in New Zealand history. The model will tell you that was too low, that was out of whack. So they've normalised now. As a final takeaway from this, you look at the very end of that chart, you can see fair value gradually rising. Now, this is a very slow-moving kind of long-run model, and my guess is that the next few quarters, if I updated this, will show that that fair value continues to rise. In other words, it'll say that fair value for long-term interest rates will probably be higher in the future. And I'll finish there. Thank you very much.